Good evening, everybody. What's going on, Husky? Good to see you. CRM. I haven't looked at that one in a while. Take a look. Yeah, it's working slowly. I really haven't checked this one out in a long time, though. Wow. Let's zoom out a bit here. Are you talking about CRM or CRWD? Because that's the one we talked about recently when it was at the highs and now way off it. No. Yeah, we were taking a peek at this one way up here, and when that didn't work, it only got worse. Pretty impressive. CRM. Okay. Yeah, decent day. Green and everything else is red. That's definitely helpful. Hmm. Yeah, not a bad day on it. Volume picking up a little bit. It's an interesting one though. I think it's a little bit hard to get too excited about bounces when we're cracking the 50-day MA here on the S&P. Same thing with the Qs coming into this larger trend. Definitely still a time to be a bit patient. CVS. CVS is flat today, man. How about like Home Depot or Walgreens? Yeah, not too much going on today. Energy's a little hot. Yeah, pretty much nicely summarized day with a move lower into tomorrow's PCE print. That's really going to be probably the driving force for the trend tomorrow. No, you didn't, Spike. We're just barely getting started. Just talking through a couple names. That swing is mentioning. You're right on time. I'm just gonna get another message ready, letting everybody know that we're gonna get going soon before we officially get started. Any questions or comments before we get started? I know hopefully every one of you were at the lecture last night, so you're all warmed up on the concepts, ready to keep it going tonight. What is the green and red indicator on the price? Yeah, so that's a EMA cloud. I have that one posted in my tab. I think I posted the link to it last night. I'll post a link to it again as well, just so you have it. Um, Really, all it is it just calculates this cloud based on the 10 and 20 EMA, or technically however you configure it. So the way I have it set up, if we open it up and look at it really quick, you can see that I have it gives you the option to set two moving averages. So I have the 10 and 20 set, and then both of these set to exponential, but you can set them any way you want. And then what it does is if the shorter moving average is over the longer moving average, so 10 above the 20 in this case, it paints this cloud green. And then when the 10 is below the 20, it paints this cloud red. So it's pretty simple. It's just, I think, a little bit nicer to visualize kind of the short-term trend in this way. At least that's how I feel. But yeah, I like it. Yeah, it's on the tab. I just threw the link in the chat there, so you can go ahead and grab it straight from there. And then one thing to note is that there's been a lot of interesting issues with the studies in TLS. Like you used to be able to just click the link and click import and it would work, but that doesn't seem to work anymore. So you actually have to go into setup, open shared item, and then put the URL in here and click import, and then it'll work. But I don't know why you have to go that extra mile now. It's pretty annoying. All right. A little bit of a thinner crowd tonight, but that's okay. So yeah, let's get right into it, everybody. As you guys know, we're going through the volume price analysis course series. Last night we did lecture 2, and tonight we're going to keep it going right into lecture 3. So if you weren't in lecture from last night, I'll just go ahead and give the quick introduction, but it's only going to get quicker as we continue to move on because, yeah, hopefully expecting everybody to have the context by now. We've been doing this short little course series, total of 6 lectures. We've done 2 so far. We did the first lecture about 2 weeks ago, and then the second one last night. So yeah, this is going to be the third one. Hopefully everybody's pretty familiar with the format by now. But for the most part, these classes generally start with more basic information at the beginning, and then as we move throughout the class, the content that we cover gets slightly more complicated as we move on. And yeah, that's a good point, Raphael. Actually, I saw that DM come through today, and I don't remember if I responded to you or not, but yeah, Raphael did create a playlist on YouTube, which I'll go ahead and just post it in the chat if you guys are interested. He's doing the extra mile here, and I guess I'll open it up too. Got all the lectures organized, and yeah, hopefully all set up for us. Yeah, so he's got, wait, cycle of price action. Oh, so he's even got this. Okay, cool. Yeah, so he's got a lecture that was before the course series, and then one as we got into it. So yeah, pretty cool that he's doing that for us. Appreciate that, Raphael. Swings out a quick question. Nando uses the BT Cloud. I don't know. It's probably the same thing. I haven't really paid attention to what Nando's using, but I would assume it's probably the same thing. Yeah, so it's just an EMA cloud at the end of the day. There's only so much you could do. All right, and then next up, as we've been doing in every lecture, I wouldn't be doing this book. I would be doing this book a disservice without giving it a shout out. A lot of the content that we discuss is rooted in this book. We definitely deviate from it, and definitely use it as kind of our foundations rather than the end all be all. However, definitely have to mention this book, A Complete Guide to Volume Price Analysis. Really good book. Again, as I mentioned in every lecture before, I don't get compensated to shout it out. I don't get any money if you guys buy the book. It means nothing to me if you buy it or don't. But if you like what we talk about in this class and you want to get a little bit more detail, definitely check out the book. All right, talking about where we are in the course series, we're on lecture 3 here. So last time we did the foundations, and today we're going to talk through applications. As you guys know, it's going to continue to get a little bit more complicated as we progress throughout the classes. And this class in specific, we should be definitely building a lot on what we talked about last night. So it should feel pretty nice and pretty smooth compared to what we talked about. So we'll just get right into it. We're going to do just a quick recap of what we talked about last class. I know it was just last night, but either way, wouldn't hurt to go back and remind everybody what we talked about, and also maybe touch on this for those who didn't make it to last night's class. A lot of the concepts that or concepts and examples that we covered were rooted in this idea of effort versus result, which again, we talked about how generally speaking, you want to see that effort match the result. So for example, based on volume is typically the effort, right? And as a reminder, volume represents the amount of shares traded in a given period. And typically you want to see that level of effort match the result that you get. And again, as a reminder, that result that you're expecting is the spread of the candlestick. So the difference between the open and closing price of a given period. And as we talked about, we covered a couple different examples to really reinforce this, but just again, as a reminder, if we get something like below average volume, we should expect a smaller size spread. So that's reflected in these kind of last two volume bars here. You can see on these prior green bars here, pretty reasonably low volume, definitely below the average. And we got a real small spread on both these bars. So that makes sense, right? We got low volume and nothing really happened, right? So that makes sense. Moving on, when we see average volume, so an average amount of shares traded, typically you could do that as kind of a simple average, or just kind of eyeball it, where you just look and tell the average is probably somewhere around this bar right here, the height of this bar. When we see average volume, we want to see an average size move. Yeah, pretty standard there. And then finally, when we see above average volume, or also that corresponds to above average effort, we should expect to see an above average result or spread size for the given time frame. So for example, you could see the 3 periods where we have the highest effort are going to be pretty much these 3 big red bars here, which if you compare that to the chart on the right, you can see this is a pretty large spread bar, pretty much the largest one in this period. And it also corresponds to the highest volume. So that makes sense. And then the next 2 large effort days also correspond to pretty large spread days as well. So mostly checks out there. Yeah, it's hopefully pretty straightforward in this idea. The one thing that probably can catch people up from time to time is when you get what's called a volume price anomaly. And this is when effort doesn't quite match up to the result. So for example, this might look like when we have below average volume and we get an average size spread, or above average volume, meaning, excuse me, a lot of effort with a smaller candle spread. So this means we put in a lot of work, a lot of buyers or sellers were present in the marketplace. However, we didn't really make much of a change over that period. So this is really the concept of effort versus result. And we covered a lot of these examples in last night's class. So I'm not really going to rehash any of those. If you're curious about some more of the details, certainly encourage you to go check those out. But for the most part, we're going to kind of move on past these. So does anybody have any questions on this before we keep going? Feel free to let me know now. I know Husky doesn't. Cool. All right. Well, if we're all feeling good, we'll just keep going right into it. So, like I mentioned last night, tonight is going to be a bit more example heavy, but I decided I wanted to cover just a few more concepts that are kind of building on top of what we talked about last night before we go all the way into kind of just straight up examples. So, we have some detailed examples towards the end of the PowerPoint, and then we'll get into just kind of browsing the charts and talking through some examples there as well. But just starting out, I want to give just a couple more kind of theory lessons before we get into those. So the first concept that we talked about is the importance of monitoring volume during a breakout or a test of a key level. And if you remember some of those examples that we talked about, we mentioned how when we see a widespread bar on high volume, typically that would correspond to a strong breakout, right? And we reviewed a couple examples where we saw that sort of widespread bar on high volume. And most times it's a higher probability that you're going to see that continuation higher. And again, obviously nothing ever moves straight up or straight down. There's going to be pullbacks, etc. However, for the most part, when you see that strong breakout on high volume, it's pretty reasonable to expect that continued move in that direction. However, again, as we mentioned, high volume generally corresponds to a strong breakout, and low volume typically corresponds to a weak breakout. So, for example, I'll just kind of draw up a quick scenario for us so we can kind of look at this together. I'm just going to draw kind of a simplified little price chart here. So let's say this is our line chart, and we're kind of making this horizontal test against resistance, right? So we set this up here where we have this kind of move in price, and we're just consolidating up against this resistance level. If we move through this level on weak volume, right? So I'll try and draw the volume bar here. We'll just say that's our volume, and this is, our average. So here's our fake volume bars here. And this is the volume that we get on the breakout. That's definitely considered more of a weak breakout, right? There isn't many buyers participating as price moves higher. So not the most ideal situation for us to participate in as well. However, if we see a move that looks a little bit more like this, where we have significantly higher volume on the breakout than we do on prior bars, that represents a strong breakout backed by volume. And again, we talked through a couple examples like this last night, so I'm not going to rehash it in too much detail, but that's really the big idea that we're trying to reinforce here. However, something that you may have heard, I know River likes to cover this a lot in his lectures, is 80% of breakouts fail. And this is a quote from Al Brooks, pretty legendary day trader. I mean, the guy's like 70 years old, been doing it for 50. So definitely knows what he's talking about. And this is kind of proven through statistics that he's measured. And it is true. 90% of breakouts do fail. So it's important for us to not only understand this, but figure out how exactly we might be able to identify when a breakout would fail and when it wouldn't fail, and when it's really time for us to participate in that high probability situation. So I want to talk about this concept called testing the market, which looks a little bit like this. So for example, paying attention to just this trend here, first of all, we have a pretty healthy looking trend. And if you take a look at the volume bars here, as we get those widespread volume or candlesticks, we're also seeing that large expansion in volume as well. Generally speaking, as price moves higher, volume is increasing. So pretty healthy trend. For the most part, it looks pretty solid. However, when we come up to this arbitrary breakout level right here, all of a sudden we get a large amount of sellers, also a bearish engulfing, if you want to call it that, also a pretty widespread bar, right? So in this specific example, buyers went to test the market, right? They wanted to test this resistance level, see if they could break it. And ultimately, they were significantly overwhelmed by sellers, right? So it clearly shows that there's still a lot of sellers in the marketplace, and it probably is going to take a little bit more time for price to actually break through that level with any significance. However, kind of the converse example here is if we have that exact same trend into a similarly strong breakout level, but when we test it and we actually get there, we don't see a significant amount of sellers on that same test. that is a very positive sign, right? Remember that buyers and sellers are always present in the marketplace. However, they don't always take action at any given moment, right? There's always groups of people who want to sell shares, but that doesn't mean they're going to. Sometimes they're waiting for specific levels. Like, for example, we've talked about this in other lectures, not this specific course series, that when looking for key levels, we don't always know why a level matters. However, it's pretty easy for us to look back at a historical chart and figure out a level that's significant. So, for example, if we look back at the S&P, we could just draw a line pretty much right here, right? Which this level has some significance from before, right? This was a prior all-time high. You'll notice when we came back and retested it, we found buyers at that same spot. Same idea here, right? A prior all-time high. We came back and retested it, found buyers in kind of for a short bounce, but ultimately crashed below it. So we want to be monitoring what the volume is looking like as we come in to test the market at these key levels. And again, this isn't necessarily a class on support and resistance, so I'm not going to cover finding key levels in too much detail. However, the most important thing for us to all understand is that there are key levels in the market where buyers and sellers are more inclined to participate in the marketplace. And we're going to talk about this concept a little bit more throughout the lecture. However, for now, let's just identify and kind of establish there are places where people are more inclined to trade. And again, that could be for a multitude of different reasons, whether it's the valuation is low at that given level, whether it's a nice round number like 100 or 200. It could be a time, right? It just happened to be a coincidence where there's a specific time where there was more trading activity, whether it's a news event or an FOMC or an economic release. Anyway, that was a long way for me to say that in this specific example, we're testing a key level that's kind of arbitrary. We don't know why it matters. We just know that this specific level right here that we're rejecting is important. And when we see that large group of sellers step into that level, essentially what that shows us is that sellers are still camped out at that level, and they are still essentially holding the line at that level. They are ready to continue offloading shares at that level for whatever reason. However, in the second example here, we reach that exact same level. We get that test from sellers, right, where they try to show up. We have that little bit lower wick. However, volume is very low, right, which shows us that, yeah, there was some sellers, but they're really insignificant, which this specific scenario should tell us that we should probably be breaking out of this level very soon. And when we do, it's probably when we want to buy because there's really no more sellers in this area anymore. Whereas with this specific example, it should be pretty evident, number one, that we're probably not going to be breaking this level on the next candle, considering the amount of sellers. And number two, we should probably wait on trying to trade the breakout for a little bit, maybe wait for a retest of support lower, or even just wait for this amount of selling volume to die down a bit before we get comfortable trying to purchase this given equity at this level. Does that make sense to everybody so far? And again, we kind of talked about this last night when we talked about kind of high volume app breakouts, high volume app support. It's the same idea, right? For example, you have to remember that there is some reason that buyers and sellers want to trade at a given level, right? And at a resistance level, it's common to expect sellers to step into the marketplace. When we see them step into the marketplace with this much significant, it's kind of a warning to us. It lets us know, hey, even though we had this uptrend, sellers are still very much in control of this specific area of the chart. Kind of like we talked about in the first lecture, the marketplace is a pretty constant tug of war between buyers and sellers, right? Which both groups are always fighting for control of the trend. And again, here, this is really just a signal saying, while sellers or buyers made a good run, sellers are still definitely in control. And again, in the second example, this low volume is very evident in showing us that there aren't really many sellers in the marketplace anymore. James, interesting question. He asked, does the MACD measure the volume we should be watching? So the short answer is no. The MACD is strictly based on price, and it uses a couple moving averages to make a histogram, essentially, that monitors the crossing up and down of those moving averages and can give buy and sell signals based on that. So the MACD has pretty much no relationship to volume whatsoever. It doesn't monitor volume. It isn't calculated based on volume. It's strictly calculated based on price. And it's also typically regarded as more of a lagging indicator, whereas volume is probably one of the only leading or at least on-time indicators in the market, because volume shows you exactly what is going on in that given moment, right? Volume shows the real buying and selling activity. And we can even show this on something like futures, which are trading overnight. If we take a look at the 1 minute, we can just kind of watch this change real quick. So I'll just zoom into this little area here. So it's overnight, so it's not going to trade super rapidly, but hopefully we'll be able to see some change here so you can kind of see what I'm talking about. Okay, so that candle just closed. We had 14 volume. Now we have 18. Again, moving pretty slow. We're a couple hours after the close, so it shouldn't be anything too rapid, but just trying to illustrate this concept if we can. Okay, now we're up to 20, 24, 34. So really this volume is increasing as the number of shares, or in this case, contracts traded increases. So we're at 34 now, there we go, 45. And you can see these increases in volume or changes in volume directly correspond to movements in price. So I don't know if you're able to track both right now, but you can see as this volume is moving higher, we're getting these kind of moves in price, right? So honestly, this is a decent example of volume price analysis as well, right? I know we're on the 1 minute, so it's not very significant, but it's pretty clear that we have two really big buy bars in the last period where this only sell bar is pretty much average, right? So this actually is a decent example of what looks like a pretty decent breakout setting up. So actually, I kind of want to just watch this real quick and see what happens. So watching this approximately 54.50 level on ES, you could see we're kind of sitting under, oh, wow, this is actually a perfect example live talking about this concept. So let's just watch this for a little bit. It's only on the 1 minute. Again, right, this is future, so really anything could happen, but this is really illustrating the patterns we'd want to see. For now, right, we have high buy volume as we come into this level, and sellers aren't really stepping in with any significance, right? We don't have any significant sellers yet. Here, we just got a big amount of sellers that stepped in the marketplace. Okay, now we're getting buyers stepping in. Back to this test here. Okay, let's just wait and watch a little bit, see how this bar closes, because now I'm actually kind of interested. This might be a decent example. Yeah, volume doesn't show fully all the way. So how do you know if it's going to be a candle with a huge volume if it comes in slowly? Yeah, that's a great point, right? So when you're monitoring volume, you have to remember that it is changing in real time. Like we're watching volume change as the candles open. So what that means is that we can't make any conclusions based on volume until the candle actually closes. So for example, this bar here closed on actually increasing sell volume as it rejects this level. So again, not a huge problem, right? Still about average volume as a whole. So not something to necessarily cry and write home about, but still, you know, a little bit of a change there. But important to note, and I guess I haven't really made this clear in previous classes, but important to note that volume can only be measured when candles are closed. So you can't be doing analysis on the volume of an open candle, right? Because it's so close. We don't know how much volume this period is going to end in. And we also don't know how this candle will close. Like right now, this bar is red with no wicks, right? But I guarantee you, well, I shouldn't say that because the candle's about to close in 3 minutes. But typically, right, especially when you're not looking at a 1 minute chart after hours, the bar changes very significantly throughout the period the candle is open. Again, this is futures after hours, so it's going to be a bit slower, a bit funkier. But anyway, that's the big idea. So like, for example, when we see this green bar on all this volume, we can't be like, ooh, you know, this is a high volume. This is for sure the bounce, the lows are in, right? No, we can't say that. All right, we'll come back and check on this example in a couple minutes and see what happens. But definitely, the patterns are reasonably positive, right? We have some nice buy volume as we come into this level of resistance. No significant sellers stepping up, ooh, except right there. But still, no significant sellers stepping up, right? We'll have to wait to see how this bar closes. Now volume picking up a bit. Yeah, lots of volume coming in right now. So this is, again, kind of still continuing to confirm that pattern if we close this bar green, looking nice. But yeah, I will just wait for this bar to close and switch back to the charts. So this is looking like it's actually going to close as what would be an anomaly, right? We have a very small spread bar on above average volume, right? So this is an anomaly, right? So it's not necessarily a signal for us to do anything, but something for us to know, right? Really high volume, no result. Also kind of at what you could consider to be a level of support, the moving averages. Again, we're doing this analysis on the 1 minute, so you could argue how it might be kind of trivial. But anyway, it's actually illustrating the concept kind of decently. All right. So you don't know till the end of the candle for the full volume, then you won't always be late to an entry. Technically, no. Technically, you'd be right on time if you're waiting for the candle to close. Yeah, if you're not waiting for candles to close, you're early, and if you're early, you're wrong. That's pretty much it. If you're early, You're early is not right. Being early to a trade is wrong, right? Because if you're early to a trade, that means what you're looking for hasn't happened yet. Whether you're looking for a bounce, whether you're looking for a breakout, or whoever knows what else. If you're early, you're wrong. Plain and simple, right? Early is not necessarily a good thing. And actually, in this case, if you consider waiting for the bar to close being late, which I personally wouldn't consider that being late because technically that's what you need to see, right? For example, if I just decided to get long, when this bar was green on all this volume because it looked like it was looking good, well, yeah, I was early, but right now I'm wrong. And again, this is a 1 minute, so it doesn't really matter. But anyway, all right. So I want to switch gears a little bit and kind of continue to expand the concepts that we've talked about into a larger scope. So this is a really kind of obscure analogy at first, but think of what it takes to fill and empty a warehouse, right? And I want to kind of spin this analogy up a little bit more. So imagine a supplier is starting out its new distribution company, right? Or its new distribution warehouse. Even you could think of like Amazon, right? Is opening up a new warehouse. And obviously when that warehouse opens, it's completely empty. And as Amazon, right, they're looking to make money on the goods that they're selling, right? So whether it's from third-party people or whether it's from things that they manufacture on their own. So when Amazon's filling up that warehouse, it's going to take time, right? They need to either procure or manufacture the goods that they want to sell from their warehouse. So it takes time to fill that up. And additionally, it's going to take time to get goods at the right price. Amazon wouldn't be looking to overpay for their goods, right? Because that's their bottom line. So if they pay too much for their supplies, all of a sudden their cost of goods sold, their costs of goods sold goes up pretty significantly, right? Like, for example, if they know that some Chinese factory is about to open up and be able to manufacture their stuff for a couple cents cheaper, well, if they're buying 100,000 lots, they're probably going to want to wait for that to be finished so they can buy those units at a lower price. So the big idea is when a company is filling a warehouse, it takes time, right? It's not something that happens overnight, especially if it's a large warehouse. And number two, when you're filling a warehouse with inventory, you want to get it at a good price, right? Because if you're buying and selling some kind of commodity, well, at the end of the day, you want to buy it cheaper and sell it for more, or buy it for an expensive price and sell it for more. No matter what, there's got to be a margin in there for you to make money. So you want to be waiting to buy those goods at a price that's good, or go somewhere else and buy from somebody who's selling the same thing for cheaper. Conversely, when you're emptying a warehouse, right, it's not something that can be done in a day, right? If you're selling to things like a retail consumer or people smaller than you, for example, Amazon is one of the largest online retailers. So there's not somebody as big as them who's going to say, all right, Amazon, I want to buy everything in all your warehouses. That's not how it works, right? It ends up being smaller buys over a larger amount of time. So people buy here, people buy there, but also there could be those larger consumers as well, right? People buying in big chunks at a given moment. And ultimately, this cycle can repeat. Now, obviously, this probably isn't how Amazon runs their warehouses, right? They probably don't fully fill and then fully empty and fully fill, right? That's not necessarily optimal. However, hopefully it gets the point across. So I also use the AI to generate these images because I thought it'd be kind of fun, but I don't know why I included them in here. So this is something that smart money, or kind of the most kind of significant investment groups, do, right? And these two kind of things that they perform are accumulation and distribution. The first concept that I want to introduce is accumulation. In general, stocks are accumulated by smart money at low prices. For example, the most intelligent, the smartest investors, the people with the most inside relationships, the connections, the people with the best foresight are always going to be buying at the right price. And unfortunately for them, big money can't necessarily just buy one share here, one share there, because, well, it takes forever to do that, right? They have to buy in some larger chunks here and there because they have millions and billions of dollars. You're not just going to buy one share every minute of every day, because all of a sudden that's kind of risking the price that they're actually going to get filled at. So they need to arrange large transactions in order to purchase the shares that they want. And this is called the accumulation phase. And I want to show you what this might look like on a chart. So you can kind of see what this looks like illustrated. So for example, when a set of stocks moves or transitions from an uptrend into a downtrend, typically you're going to see it form some kind of new long-term base. And this is something that I've covered in my tab with so many different trade ideas over the past 2 years. Not so many recently, as a lot of names have moved out of these long-term bases, but we'll talk about a few examples. It's very common to see as stocks move lower, the volume begins to pick up as the stock trades within that base. And you can see we have plenty of these high volume bars when the stock just sits in range, right? Which again, you could think of as an anomaly, right? This is us expanding that concept of an anomaly to have a little bit of a wider scope. So for example, when we see this large volume come in and the stock is effectively going nowhere, right, sitting in a range, that tells us that some institutional investors are beginning to accumulate a position in a given equity. And remember, they're always buying at the best price, and they're always going to be taking these large blocks of trade because that's what it takes, right? If they want to get $1 billion position, it takes a lot of time and it takes big trades to get those shares at the price that they want. And ultimately, right, this accumulation phase typically happens when most other people aren't willing to buy, right? Typical retail investors are generally scared to buy, and dumber and smaller fund managers are typically scared of buying during these periods. It's the smartest, most institutionalized investors with the most amount of money that are always buying and selling at the right price. And that's the reality of the marketplace, right? At the end of the day, markets and equities as a whole are moved by these institutional investors with large amounts of money. Retail investors have no impact at the end of the day, right? We do nothing. No matter what you want to think, retail investors actually have zero significance in the marketplace. That said, those institutional investors are really what move the market. And as they accumulate their position, ultimately they're looking to make money on that. So at the end of the day, that stock typically will move higher for whatever reason, right? Whether they've done some research, whether they have some media campaigns, whether they're anticipating a good earnings report, or whether they're looking at future guidance in a different way than other people. Regardless of what they're looking for, they're positioning themselves to make money off of future price appreciation. So it's our job to identify when a stock is in an accumulation phase such as this, in order to also take that same position when we see that breakout of the accumulation phase. And we'll go through some real examples to talk through what this actually means, because I know it's probably a bit obscure for now. So if you have too many questions, don't stress. We'll cover some real examples that might help you figure it out a bit more. Helmy, yeah, so Flips often says big volume coming, whether on upside or downside. How can you see that? Yeah, so he's looking at flow typically when he says that, which flow, you don't have to wait for any candlesticks to close or anything like that. It's just coming in real time. So it's essentially just like volume where it's live trades hitting. It just tells you, hey, somebody just bought 300,000 call options, right? So that's pretty important. That's one thing he's doing. He also commonly looks at the tape or level twos, which help him monitor that in real time, which that's not something that we're really covering in much detail today. All right. So moving on to kind of the opposite side of the coin is distribution, right? Which again, might be pretty obvious after what we covered so far. Stocks are distributed or sold by smart money at high prices, which is the distribution phase. And you can see, again, this looks very, very similar to what we covered in this previous slide. It's just the opposite, right? So essentially, the given equity has moved in the direction that big money wanted it to, and they're able to begin taking profit on their position. And same way they accumulated their position, takes a little bit of time for them to offload it all. But once they do, right, and they've sold all their shares, it's pretty common to see that stock beginning to move lower. And again, somehow institutional investors with the most money and the most intelligence and the most assets are, generally speaking, always in the loop. They're always on time for everything, right? Which is something that isn't a reality for retail investors, right? We just don't have the resources that they do. But at the end of the day, it's our job to monitor what big money is doing through volume price analysis and make informed decisions based on that. So I wanted to just cover this really quick. This kind of accumulation and distribution idea should remind you a lot of this idea of stage analysis, which I've covered in a lecture before, which I think Raphael had in his playlist. So I'm not going to cover it too much. I just wanted to mention it really quick. Stage analysis is kind of a similar philosophy that says stocks go through these kind of same 4 phases, where you have the accumulation phase in stage 1, the distribution phase in stage 3, and then stage 2 and 4 are the trends in between. So stage 2 is kind of that trend higher. Stage 4 is that trend lower. And again, this is just kind of an extra way to look for accumulation distribution. So kind of in addition to the volume price analysis concepts. The way this is monitored is typically the 40-week moving average. And what you want to see is in that stage one or accumulation phase, you want to see that 40-week moving average begin to flatten out and turn to the upwards, right? So once you see the slope begin to increase in that 40-week moving average and price begin to break out above that, that's typically when the same kind of analogy before, the campaign's over, right? The institutional investors have loaded their warehouse full of shares at the right price, and they're ready for price to move higher. And the same thing goes for the distribution phase. It's pretty common to see that 40-week moving average begin to flatten out a little bit, and then also begin to turn to the downside when that distribution begins. So again, as I mentioned, this stage one and stage three are pretty analogous to this accumulation and distribution concepts from VPA. So I want to just go right into the real world examples because I'm assuming that probably confused some of you, and I think the real world examples will help. But if you have any comments or questions, I think now is a good time. If you want to just go ahead and throw them in the chat, anything I can clarify now before we get into some examples, go ahead and toss them in the chat if you have them. Anything so far? I have a feeling we're going to spend the last 20 minutes of class on these two examples, so buckle up. Is it necessary to So yeah, that's actually a very interesting question, Swing. And that was actually the same thing that we saw. Oh yeah, look what happened. Awesome. This is beautiful. Check this out, guys. Checking back on this chart. Look at this. This is exactly the volume price analysis concepts we would be hoping to see here. This is the 1 minute. Again, this is the 1 minute, but we literally talked about this, right? This is exactly what you would expect. So again, right, this is a beautiful example live happening right now. Wow, this is actually amazing that this is happening. Wow, this is actually really cool. It's only a 3-point move, so it's not a really big deal, but the concept is like perfectly playing out right. Wow. Oh, this is awesome. This is a perfect example. Wow. Okay, so let's talk through this really quick. This is going to be our first real world example, right? So check this out. Wow. Okay, I'm kind of freaking out a little bit. This is like a perfect cherry picked example. Check this out, guys. Let's talk through this really quick. This is great. Happening live too. And wow, this really just shows you the power of volume price analysis, right? We just did this on the 1 minute chart, threw this together, and it actually happened in real time, literally right in front of us. Again, 1 minute chart, so not a big deal. But anyway, so let's just talk through this, right? First, we get this first test of resistance, right? First test of this resistance level. I don't know if this is a real resistance level. I don't know what this level is, honestly. This was just a prior pivot, right? So I don't know why this level matters. It just looks like it does. Here, as we tested this level, massive selling volume, right? Massive. And notice it took a long time for us to recover to that level, right? This is a perfect example of the test of this resistance level failing, right? We had a beautiful looking trend, right? Look at this, rising volume as price moves higher. But once we get to this level, all of a sudden, all these sellers step in the marketplace, right? This is huge. This is huge, right? This is a massive red flag. There's no reason at all, no reason to be trying to look long after a move like that, right? No reason. However, we come back up an hour later, retest this same exact level, right? We get a nice amount of buyers coming through as we come back into this level. And again, it's probably a little bit more of a zone after this test, right? So it looks a bit more like this. But anyway, we come back up into this level, right? We get this initial kind of rejection, right? So that's a little bit of a red flag. We have this high volume and equal size spread as the previous bar. So a bit of a red flag. But again, buyers stay strong. And after this test of resistance, this is the key right here. After this test, there is no high volume in sellers. We have this one anomaly. Excuse me. We have this one anomaly bar, but as I mentioned, right, anomalies aren't necessarily a signal. It just means we have to wait a little bit, right? We have to take a step back and say, okay, we got this high volume out of nowhere. We don't really know what's going on. So just be patient, right? Which we already should have been being patient after we saw this test of resistance. Then all of a sudden we get two massive bars of volume. This one's interesting because this is actually a bit of an anomaly, right? Much more volume as we break out, but smaller spread. So bit of an anomaly, but again, right? Just a reason for us to wait. Still very high volume as prices breaking the level, so still a good sign. And then the first red candle, first retest, is back down to average volume. which is exactly what you want to see after a breakout, right? You don't want to see a large amount of sellers stepping up in the marketplace. You want to see that number of sellers stay low, right? And lo and behold, price continued a couple points higher, right? This is futures, so it's not a big deal, but 3 points in futures, that's a great scalp, right? 3 points in futures, what is it, $50 a tick? That's $150 if you're trading one contract at ES. At least I think that's how it works. I don't trade futures. But anyway, it's decent money, right? Not a damn thing wrong with it. So this is the exact concept of testing the market live, and this is crazy. Yeah, Aaron, exactly. The entry probably would have been the low volume red candle when it retests. Absolutely. Right. Because after this anomaly, although this is a retest, me personally, I probably still would have waited because that's a little weird the way that turned out. And this is just going to be a consequence of after hours futures, right? Maybe futures traders that are a little bit more familiar with the overnight market, it's the same thing. But certainly after we get this retest on low volume, there's no reason to be short. And if there's no reason to be short, you got to be long. That's always the story, right? We have this breakout above previous horizontal resistance. Trend is up. Volume price analysis is positive, right? Our volume patterns are positive. And as we get this retest, we have barely any sellers, which means sellers have officially been overwhelmed, right? The buyers remain strong and the buyers win this game of tug of war, right? Which has led to an excellent 3-point move. And again, right, this is the 1 minute. We can take a look at what this looks like on the 5 minute, and maybe it's a little bit more clear. Let's see. Let's check this out on the 5 minute. Might be a bit nicer because I personally don't ever trade on the 1 minute, and I don't really recommend anybody else to, but you guys do whatever you want. Let's see. Okay. So it actually looks even better on the 5 minute. Honestly, this is like perfect on the 5 minute. This is literally textbook. So check this out, right? Again, high volume as we come into resistance, exactly what we want to see. Big volume from sellers, which is not a good sign, right? That means we want to wait, take a step back. Then on the 5 minute, no more high selling volume on this move lower. We approach this level of resistance again on high volume. Then this move lower, we get average selling volume, which declines, right? And then when we break out of this horizontal level, again, high volume right here. And then again, right, as we continue our breakout above this level, another high volume bar, which this is a reason for us to hold, right? This is volume validating price right now. We're literally seeing it live, right? As the spread of the candle gets larger, volume is picking up to the upside, which is exactly what we want to see, right? We should trim at levels of resistance, right? Which looks like this actually is a level of resistance right here. We should be trimming at levels of resistance. However, we should leave some of our position on the table, right? Because there's no reason to sell fully. We're seeing exactly what we want. As price moves higher through this horizontal resistance level, we're seeing more buyers step into the marketplace. Again, exactly what you want. And again, now notable, this candle is about to close in about 10 seconds, and we've seen a big drop-off in buying volume, right? Big drop-off in volume as we're seeing a little bit of a rejection of this key level, right? Which, not a big red flag, not a reason to kind of freak out and sell the house, but probably time to let us know that, okay, we might see a little bit of consolidation here, right? This breakout might cool down a bit for a bar or two. So if I was looking at the 1 minute, I would have traded it on that red candle. So that first breakout and retest. If I was trading it on the 5 minute, it's a bit different. We didn't quite get the retest, which is okay, right? If you get a nice breakout bar with no retest, it is still okay to trade that. You just have to make sure your risk is defined, right? So for example, if this breakout bar blew my entry level out of the water, so my entry level is this 54.58 level, this candle closed at 54.59. So I would trade a break back below this level, which is only about a point risk. And if my profit target is 5 points higher, that's perfectly fine. However, if this bar closed, let's say it closed at something like 54.80, right? 54.80, and it looked like this. I'm just going to simulate it real quick. If it looks something like this is absolutely a terrible trade to take, right? If you're an options trader and you're trying to get long on some calls after this candle, IV is going to be very inflated at this point, and there's no reason for you to be trading a situation like that. Because at this point, you're light. We didn't get a nice clean breakout. We didn't get a nice retest. Whatever, it happens. Just stay away. It's okay. There's going to be a better entry in the future, but don't chase something like that. So it is a bit arbitrary. For me, it really comes all the way down to risk to reward, though. And we'll talk a little bit more about this in the trading strategy course. But the big idea is that since this breakout bar closed above our key level and it was still pretty proximal to that level. So again, as I mentioned, this bar closed at 54.59.75, which is pretty much $1 above our entry level. And if our profit target was $3 higher in this specific case, that's 3-to-1 risk to reward, right? That's still great. Hopefully that makes sense. But wow, what a nice example live for us. Everybody clear on that? Again, totally impromptu. Obviously, I wasn't planning for that, but yeah, does that make sense? Why that example kind of perfectly aligns with what we've been talking about? All right, Johnny. Happy to see you. I think Johnny's been in the last 3 lectures. I know you were here last night, and I'm pretty sure I saw you in the first one too. So thanks for being here. And let me know how you guys are feeling. I mean, how many of you have been able to see all 3 lectures so far? What are you guys thinking? Is this progressing the way that you would expect it to? Is kind of it starting to get a little bit more complicated and things are really starting to come together? You can say no, by the way. I won't be offended. I just really want to make sure you guys are getting the value I sold off this class because I probably hyped it up a little bit. But I want to make sure you're getting what you expected out of it. Awesome. Yeah, this is really the power of volume price analysis, everybody. It's simple, right? It's really simple. At the end of the day, it's not that complicated. And it adds so much value to your trading. So much value. Awesome. Yeah, that example was perfect, honestly. We got really lucky with that, right? And again, right, as I mentioned, there's no reason to fully sell this trade. There's still no reason to fully sell, right? We have no indication that sellers have stepped up in significance. No reason to sell. Again, always trim, but why not hold your position for a little bit, right? Set a stop loss and profits. Let this thing ride. If we actually traded this is the best position to be in as a trader. You're not asking yourself if you're going to make money. You're asking yourself, how much money am I going to make? You know you're right. Volume continued to validate price on the breakout, and it looks like it's about to validate price even more, right? It looks like this volume's about to increase past this prior bar. Maybe not. Maybe I'll be wrong. But anyway, it looks like volume's going to continue to validate price. So this is exactly what we want, right? This is exactly what we're looking for in a trade that we're in. So volume price analysis isn't just used to get you into trades, but it can also help you stay in trades, right? Using volume price analysis can help you have the confidence to continue to realize that, hey, I should still be in this trade, right? So here we go. I mean, we'll just finish watching this live example for another 40 seconds. Now we're seeing buy volume outpace the previous candle's volume, which is good. The candle's not closed though. So if this candle closes above this level, that almost could be another entry if you really wanted to take it. It's a bit risky considering we're so excited for the moving averages, but technically it's something that you could take because this trend is still healthy. So we'll wait and see how this closes. We got the high volume we want though, which is great. We're seeing that volume increase live. And this is kind of the thought process that you can follow, right? We're watching that volume increase as we're watching the chart. You can see the clock up here. You know we have 3 seconds left till the candle closes. All right, so it looks like we're just barely squeaked over that candle, just barely squeaked over. So probably not the strongest signal to be a buyer, but if you're already in a position, right, you're certainly good to keep holding. All right, very nice. And I mean, honestly, probably at this point, I wouldn't be surprised to see a retest of this 54.60 area, right back into the moving averages. But again, it's overnight, right? Futures overnight are a bit different. But anyway, all right, let's talk through a couple more examples, some ones that I prepared on the PowerPoint here, and that should close us out for the evening. So the first one that I wanted to talk about is this idea of testing the market. Again, this is a little bit rough. One thing that I talk about in some of the lectures is, and this is also something that I learned from Shark over 2 years ago now, when you're drawing support resistance, sometimes it's best to squint because the market is an art, not a science. It's not going to perfectly hit your level and turn around every single time. It's just not how it works, right? So in this case, we have this key psychological level, 150. And you can see these wicks and rejections are pretty much right around this $150 spot. So we have this first rejection here, another one here, 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 and here. What you'll notice is that as we continue to reject, well, I guess I'll ask the question, what do you notice as we continue to reject this level? What's the trend that you see here, right? We have 5 rejections of this level. 5 times we tried to break out. this is our same concept of 80% of breakouts fail, right? We tried to break out 5 times. And every single time, what's happening, right? What's different in these ovals? What do we think? Throw a guess in the chat if you don't know. But what do you guys think? What's the difference with every single one of these tests? It's definitely highlighted in these ovals. Yeah, exactly. Volumes dropping as we continue to test that level. Absolutely. It's an indication to us that the amount of sellers in the marketplace are decreasing. Also, over time, the candle spread is kind of decreasing as well, right? We have this massive one here, then it kind of trends to be smaller. It's a little inconsistent, but the most important thing is that volume is dropping off so significantly as we continue to tag this level. There's less and less and less sellers every single attempt. And you have to remember, at any given level, there's a set amount of people who want to sell there, right? They've made the decision. They say, hey, I probably want to sell at 150. And that's generally the big group of people, right? There's some people that are going to be randomly selling there. But for the most part, institutions know where they want to sell. And ultimately, you can see over time, as we continue to tag this level, less and less people are able to sell their shares. Because what's happening here is the same idea as what we talked about earlier. Their inventory of shares is decreasing, right? And this could be a group of multiple firms. It could be a single firm. It could be a bunch of retail sellers, right? Who knows? But at the end of the day, the overall amount of shares willing to be sold at this level is dropping, which tells us that sellers are weakening in the marketplace. So when we see this, it's not necessarily a sign to instantly get long. I'm not going to say that, right? I'm not going to say that at all. I will say, though, when we do get a more concrete signal to get long, this just aids the probabilities of us being correct. And in my opinion, we get that signal right here, right? Where we have this massive gap up above this $150 level and perfect retest of the level on low selling volume, right? And also, even if you didn't trust this first retest, you could wait and see, right? Once we start to move off that level, buy volume increases, right? That first bar where we moved away from 150, we have massively increasing buy volume, right? So this is a perfect retest of that critical level. This is exactly what we want to see. And again, as I mentioned, right, these two signals here aren't necessarily a signal to say, buy now, right? That's not what I'm saying. It's just something for you to put in your mind when you're analyzing charts and say, okay, we have continually tested this 150 level. The amount of sellers at this 150 level are dropping. As a result, when we break above this 150 level, it's probably going to be pretty important, right? Because these seem to be the most significant sellers in the marketplace, right? For over 4 to 5 days, the highest volume on pretty much every day comes in when we reject 150, which means right now, for whatever reason, 150 is the most important level on Dell. Who knows why, but it is. So when we're reviewing charts at night or over the weekends, it's our responsibility to identify this, to look at the different timeframes and be able to see what levels matter and how volume is reacting with price at these levels. We put that into our pocketbook and we set an alert and we wait for Dell to break that key level. And obviously, a massive gap up, $10 above that level, isn't the best place to buy, right? Why would you buy on a $10 gap up over a key level, right? That's the exact same example we talked about, right? You got to wait for a retest or miss out. The number one rule in trading is it's always better to regret not getting into a position than wish you were out of a position. And I promise, if you decided it was a good idea to buy this massive gap up at 160, you probably wouldn't be very happy at 150. Now, if you have a lot of discipline and you know you're prepared to come down to 150, if you're ready for that, sure, whatever, buy the gap to 160. I don't care. But just know this is the level that matters. Nice example on Dell. The next example I wanted to cover is a little bit more related to the accumulation and distribution concept. And this one's on Shop. This is an idea that I'm pretty sure I posted in my tab and it was still forming. Let's just see. I do want to show you guys that this isn't all hindsight analysis. Let me just see if I can find it. Shop. Here. This is going to take me a second. Sorry. I want to show you guys what this looked like a long time ago. Pull it up here. We've been watching this one for a really long time. Not quite it. This is back in 23. Let's see. I think it's right around here. That's what I'm looking for. No, that's not quite it. I mean, it's the same idea. That's not quite it. Maybe I didn't highlight it as clear as I thought I did in the tab. Okay, maybe I'm lying. All right, sorry. I wasted everybody's time. I guess I lied. Anyway, I thought that I posted this in my tab, but I guess I didn't. Anyway, this pretty perfectly highlights the concept of accumulation and distribution, where you can see this kind of box down around this area. It's pretty evident we have multiple areas of high volume as we sit within this box, right? And sometimes it comes as we break out of the box. But for the most part, it's pretty clear that volume throughout this period is well above average, right? Look at the period we've been trading in, right? This is the average volume. And in this specific area, volume is 2 to 3 times the average almost every week, which is a sign to us that somebody is making changes in their position, right? Somebody is either making big buys or big sells. And when we're not getting any movement in price and we're at a significant low, probably reasonable to think that somebody is making some massive buys. Somebody asked a good question. Is that how you find levels over the weekend? Find the highest volume on support and resistance. It's not the only way, but definitely part of it. Looking at the daily and seeing that volume come in off those levels, definitely a big help. I also love looking at the volume profile. That's a big one, which isn't exactly the method that we just showed, but it's the same idea. So the answer is yes. That is one way I find levels, not the only way, but one of the most important ways. Oh, wow, Brian's in here. Yeah, that Dell example was without pre-market, just because it was a bit easier to see that way. I don't know what was going on in pre-market. Yes, tell me. Any time frame. Well, actually, what are you asking about? Can you use what on any time frame? Sorry, I'll wait for you to clarify. We're all staring at how me. Same with shop, right? You don't use pre-market for volume price analysis because the volume isn't huge compared to that. Well, this example, Brian, is the weekly. So technically pre-market's included here. But yeah, for names, for just in general, Brian, for names that I've been swing trading, I've kind of stopped looking at pre-market just because I'm not really concerned about what's going on in the lower time frames. It's always I'm trying to focus more on the higher time frames essentially as a swing trader. So I it's a little bit less common for me to care about what's going on in pre-market as much and focused on just kind of the hourly. Now, obviously, if it's not like I'm going to fully ignore it, right? I'm not going to be getting long right at pre-market high. It's just a little bit less significant to me when I'm not day trading. You're the best. All right. So same idea here on shop, right? Where we have this accumulation volume as the market's at a big swing low. Oh, that was it. I thought I had more animations on here. But this is the idea, right? This is the idea of accumulation. And you'll notice shop hit a low of about $24 and ended up moving almost to 95. So that's almost what is that? Almost a 350% increase, something like that. 350 to 375% increase. And obviously, shop has been pretty significantly lower since then. But this just goes to show big money bought at the right time, right? It bought before the stock moved about 200 to 300% higher, 200 to 400% higher, depending on where they bought. So big money always is right. And the best part about volume price analysis is nobody can hide, right? You can't hide the volume. So we're able to see it on the charts. Last thing that I wanted to mention is just the stage analysis idea that we talked about. This is the 40-week moving average here. And you can see as that 40-week begins to flatten out and begin to break above it, that's when the uptrend really began. And you can see now the 40 is kind of flattening out once again and beginning to turn into resistance, which probably isn't helping support this recent move lower. I'm sorry for coughing throughout this whole lecture, guys. Hopefully I'm not sick next week too, and hopefully I'm not as bad as I was last night. All right, so that really brings us to the end of the content. So I'm going to summarize what we talked about, stick around for any questions, and that's really going to be the end of it for us for the week. So in summary, what we covered tonight is we recapped just a couple concepts from the previous class. We discussed the significance of the accumulation and distribution. Oh, hang on, I got to fix this. Phases. Sorry, I wrote this last night. Phases. We discussed the significance of accumulation and distribution phases, not phases, and we reviewed some real world examples and also a live example, which let's check in on our live example. Yeah, so pretty much doing nothing, right? That's fine. Again, this is what we talked about, right? Very common to see a little bit of consolidation after a big breakout. And right now, there's still nothing wrong going on here. So no reason to be concerned just yet. All right. Yeah, so that's really the big idea for at least what we covered today. In the next class, we are going to start introducing some more advanced VPA concepts. We're going to cover the volume profile a little bit, talk a little bit more about some volume indicators. And then in our last two classes, we're going to talk about trading strategy in the second to last class. And then in the final class, which should be in 3 weeks now, which will be during the mastermind, so maybe some of you guys will get busy with that. We're going to host some kind of VPA workshop, and I don't know how this is going to go yet. But ideally, I want to have something kind of like a voice chat where it's mostly just all like talking about what we've learned, how we've incorporated this into our strategy, reviewing trades together. That's kind of how I see it going. And I know I've tried to have people talk on the Zoom in the past, and I feel like maybe some people don't want to or aren't comfortable with it. So I want to just start warming you guys up to the idea that now, ideally, this is just a fully open discussion. So open mic for everybody. Anybody's welcome to talk, share, talk about how they've learned, talk about maybe different things they were confused on, how they've started to implement this in their strategy, trades they've taken with volume price analysis, charts you've looked at with volume price analysis. Really just surround us all with the same topics and just talk about what we've done with what we've learned in this class. Yeah, it'll definitely be difficult, right? I don't doubt that. And maybe we'll need to have two. But yeah, I think one of the most valuable things, like obviously I'm here teaching you guys everything in one specific way. But honestly, I've seen a lot of value in people like all you guys in the lecture coming up and talking about something in a little bit of a different way, right? Because some of you, this was a brand new concept and you might have a different way of explaining it that really resounds with somebody else and really makes sense and clicks with somebody else. So I know it might not matter to you, but you might really be able to help somebody else out just by reviewing a trade you took or reviewing a way you thought about something or just asking a question. Yeah, and maybe even I'll be able to learn something from you or yeah. Anyway, obviously not mandatory, but I think it'll be really valuable for all of us to have a class like that. It'll be totally different. We've never really done something like that, but I want to try it. I think this is a good opportunity and we have so many of you engaged in the chat that yeah, hopefully you'll be willing. But anyway, just a reminder of the goals for the class. Number one is to develop successful traders who have a clear understanding of the principles of VPA, which hopefully we're moving closer to that. We're feeling a little bit better about that. And same idea with goal number two. Goal is to teach you all how to apply the techniques of VPA to help you all create an excellent trading system, which we've really got in depth into some examples tonight. We got that live example surprise as well. Lecture 5 should really, well, 5 and 6 should really help solidify that goal. And by lecture 4, you should feel pretty good about the fundamental principles. So really looking forward to the next 3 weeks. I can't appreciate enough all of you who have been here through the first 3 lectures. I know sometimes it's hard to make the time in your schedule and to have that continuity, especially when we skipped a week as well. But yeah, hope to see you guys all next week. We're going to be doing Wednesday, 9 p.m. Eastern, advanced VPA. So more concepts, a little bit more theory. I'm going to keep the examples in there because it seems like you guys really like the examples. Yeah, should be a fun one. And yeah, I can't thank you guys enough for making the time. I always mention it. These lectures are literally nothing without every single one of you guys who show up. So yeah, couldn't appreciate you guys more for being here, truly. So again, thank you guys so much. Shout out to you all and hope you guys have a great rest of your evening. If you have any comments, questions, feedback, or concerns, please send me a DM. I'm happy to work through anything with you one-on-one. Not a problem. So reach out, send me a DM. We'll handle it together. So thanks again. Have a great rest of your night, everybody. Thanks for sticking with us. And I'll see you guys all in the next one. Have a great rest of your week.